It's my great pleasure to introduce you to our audience, both here at Ottawa University and online. It really is true that you don't need much of an introduction, and the bio is there, and time is short. Richard has been the director of the globalization and development part of UNCTAD for many years. And for those of us struggling in the trenches, trying to fight against the Washington consensus during the period when it almost completely dominated the development debate, that part of UNCTAD was an incredibly important lifeline because they provided a more neutral and a more thoughtful voice, and Richard's role in all of this, I think, was really, really important and continues to be important. Richard has also co-authored a book recently, which it deals with the topic he's talking about today. So anybody who wants to follow up the arguments that he's about to present can obviously go to that book to get the arguments fleshed out. I just want to say that the issue that Richard is addressing, to me, goes to the heart of the economic debate in general. My argument for many years has been that there should never have been a discipline called economics, because all economic issues are simultaneously and integrally political economy issues. And nowhere is this more evident than in the area of finance. And just to make that point in a very pithy way, there's a quote from Keynes, which I think is incredibly prescient and profound, when Keynes says that the interest rate in a country is determined nationally, then no society is in a position to pursue its own favorite social experiments. And if you think about this comment, this very pithy comment, what it's telling you is that the interest rate doesn't just reflect economic dimensions, doesn't just reflect productivity, demand, and so on. It reflects the way a society has chosen to do the trade-offs between the social demand for efficiency, which is real, and the social demand for many other objectives, protection of child labor, environmental protection, and so on and so on. But the moment you understand that, then you understand that obviously there has to be a political mechanism to determine what that trade-off should be. And unless you are optimistic enough to think that that could happen in a meaningful way at the global level, you are then forced to think about the fact that that choice, that decision about how those trade-offs should be made is something that needs to be determined at the level of societies, hopefully democratically. But in order for that to happen, there have to be societies, first of all, meaning societies whose members identify as members of those societies and therefore assume certain responsibilities and agree to abide by the results of elections that are peaceful ways of resolving differences. If such societies don't exist, then there is no way of determining those trade-offs. The second thing that you then have to realize, that those societies, they're thus able to make decisions about those trade-offs, need to have the sovereign power to implement those decisions. And that's the nexus. When you think about it, that's the nexus that will tell you that political economy is the only topic, it is the only subject that we should be concerned about, and the nexus that Richard has addressed in that book so eloquently. Namely, we need a framework, a global framework, which accepts global interdependence, which is obviously a fact of life, but which creates space for societies to function in a meaningful way within that framework, in a cooperative way, allowing members of those societies to make those choices. And if you think about all of that, you'll understand that without those conditions being met, democracy is a word that has no content. So with that, with those introductory remarks, Richard, I'd like to invite you to, you're taking on a huge task, of course. It's a short time, the topic is huge. I look forward to your presentation.
Thank you very much, Manfred, and thank you to Ryan and the G78 for the invitation. I hope I can live up to that introduction, Manfred. That was a very eloquent but demanding way of introducing what I have to say, which to some extent I hope will also very much complement what Jim also was talking about in terms of the international dimension and support that is needed to complement the kinds of policies that are needed to address the inequities and environmental challenges that everybody is currently facing. Basically, I want to very briefly look at where we are right now in terms of the policy, the way in which policy is going. I want to look at some of the underlying systemic forces that have got us into this situation, and then I want to address the kind of architecture at the international level that I think, and the work we've been doing in UNCTAD suggests is needed to deal with the multiple crises that we are currently facing. I guess it's slightly ironic that I would have a quote from the Financial Times as here. I didn't realize that was part of the narrative. But what I put together here is three quotes that kind of over the course of the last couple of years that somehow suggest the challenge that we face. The first one is from the Financial Times. I'm not going to read these quotes, about coming immediately after the COVID shock and a very bold statement that the FT made about the need for radical change and for redistribution measures, a bigger role for the state, etc. You can read that quote there. Picked up, I think, a year later, still lingering. The idea that we had to do things very differently than we had been for the previous 30 years. In the G7 communique that came out of Cornwall in the June of last year, and the whole language around building back better, and the building back better world that we heard from the luminaries in Cornwall. And then within the space really of another year less, we now end up where we are with Jay Powell saying that we have to get rid of inflation at any cost, and essentially overturning the whole litany of commitments that were made under the rubric of building back better. And in a way, that's not so much a dramatic turn. It's very much a return to the dominant way of thinking, I think, that we've all experienced over the course of the last 20, 30 years. I mean, Powell, in his presentation, thinks he knows what caused inflation, and he thinks he has the tools to deal with it. And it's a very simple and rather crude perspective around the idea that too much money has been chasing too few goods, and that by raising interest rates and making it more costly for households and businesses to borrow money, then somehow we will very rapidly bring down the inflation that we've been experiencing and return to normal. To some extent, as is hinted at in Powell's quote, he understands that this could be a potentially painful process. He doesn't explain that the people who will be hurt the hardest by this are not the people who are responsible for the inflation in the first place. In the case of advanced economies, it has an inevitable consequence of laying off workers. And in a world, in the case of the United States, where 60% of workers are living paycheck to paycheck, it's pretty clear that it won't be people like Jay Powell who will be experiencing the pain that he is inflicting. But of course, in this highly integrated, as Manfred said, and dollarized world, the action by the Federal Reserve will, of course, lead to the exporting of deflationary policies. Other central banks already in the advanced economies have been forced to replicate that move, even in countries where inflation is not a particularly significant problem. That's to some extent true of Canada. It's also true of the country I'm in Switzerland, where central banks have already begun to replicate the moves of the Federal Reserve. And it's also happening, of course, in developing countries where the consequences of these monetary actions will be even more severe. The threat of triggering a vicious deflationary circle, I think, is particularly acute. We're already seeing that hitting many developing countries with devastating consequences, both socially, economically, and in some cases politically. So I think that's the kind of world that we are living in, and it's a world in which, particularly in advanced economies, central banks have essentially been left to dominate the economic policy agenda. Politicians have taken a backseat over the last 20 or 30 years. That's part of the neoliberal tide. And central bankers have become far more important in dictating the policy line that we've seen in advanced economies. Now, the claim, of course, is that independent and technocratic institutions, such as central banks, will produce the best and the swiftest adjustments that are needed to ensure macroeconomic balance. I think it's clear that in terms of the impacts that I've just described, that is not the case, and that right now, in terms of the situation that are facing many policymakers, we see at least in the work that we do, we see a global economy that has become weighed down by huge amounts of debt, both public and private, with footloose capital, a major source of volatility and uncertainty in the global economy. There are clearly serious supply side imbalances. That's part of the contributing factor to inflation that we've seen in recent months. There are very deep distributional divisions within countries that the inflation, the policies used to tackle inflation will almost certainly exaggerate. We're in a world of very sluggish investment, and the global economy is now slowing down much quicker than many of us thought 6 months or a year ago. And in that world, there is simply no way that hiking interest rates at the pace that is now happening will produce a soft landing. And the real danger now is that we will see the global economy crash much more harder than we thought was likely and indeed want to see. And of course, for the work that we do in an organization like UNCTAD, the kind of sad situation that we have to deal with is that the multilateral system that was set up essentially to prevent these kinds of deflationary episodes from taking hold are not fit for purpose. The absence of policy coordination, the absence of a meaningful financial safety net has become quite apparent under these circumstances. And it's, I think, very important for us to ask how we got into this. What are the underlying systemic forces that have created this highly unequal, unstable, and insecure world? And it's not just a question of ideas, I think, that is important here. It's very much ideas are important, but interests are also extremely important. It's very difficult to find the right word to describe the kind of systemic changes that we've seen over the course of the last 20 or 30 years some people refer to the financialized world. Other people refer to rentier capitalism. We, of course, all talk about the rise of neoliberalism as a dominant paradigm. To some extent, I think all these forces are at play in what we have used to describe the last 30 years as one of a hyper-globalized world. And we've very quickly the kinds of forces that have created this this hyper-globalized situation. I just to give some idea of those three forces: financial, and the rise of finance as a dominant force shaping the international political economy, I think, is familiar to everybody here. It's finance, much more than trade, has dominated the shaping of the global economy. You can see this in the chart on the right-hand side of this slide, which compares the growing weight of trade in the global economy, the blue line, with the growing weight of finance in terms of financial assets and liabilities as a percentage of global GDP. And finance has been this particularly dominant force over this period. That's coincided with the rise of private asset accumulation, which has taken place at a tremendous pace, even in the period since the global financial crisis, which was a period when everyone expected to some kind of reining in of the financial sector, given that it was the factor that contributed to the global financial crisis. The opposite, in many respects, has happened, as the figure in the middle of this slide shows, in terms of the rise of private wealth over the course of the last 10 years, and it's increased during COVID too. And overseeing that has been the emergence of independent central banks with a singular focus on inflation targeting as their policy goal. And the final figure in this slide indicates the rise of inflation targeting central banks, most of which are independent of immediate political influence over the course of the last 30 years in both developed and developing countries. So the financialization story, I think, which I guess you will all be talking about in greater detail over the course of the conference, is one that we're all familiar with. It's also gone hand in hand with I think something we're all familiar with. It tends to get less attention than the rise of unregulated financial actors, but the emergence of corporate power across all sectors of the economy, I think, is something that we need to talk about more. The two forces are intimately connected. The rise of global mergers and acquisitions over this time, although it moves in waves, is a feature of this of the rise of highly concentrated markets, with corporations with increasing amounts of economic and to some extent political power, but also various measures of concentration that have been developed. These are from work that we did in UNCTAD 3 or 4 years ago. They're a little bit dated, but I think they show this broad tendency of increasingly concentrated markets, of rising monopoly power, and to some extent a real bifurcation in the structure of corporations between very large corporations that do hold a very tenacious grip over the markets in which they're involved, and the much smaller firms that are subordinate to these large corporations. And that has an international dimension, of course, with the spread of global value chains, where the lead firms are by and large concentrated in the advanced economies, and the more vulnerable supplier firms are found in the developing world. And a feature, I think, that we've tried to emphasize in our work on this over recent years is that in this world of mounting corporate power, rent-seeking behavior by corporations has become as important, if you like, as the process of generating what economists refer to as normal profits. And the final chart on this one on this slide is our attempt to measure the rise of what we call surplus profits above normal profits amongst the largest firms, some of the largest firms in the global economy, and this notion of super profits or surplus profits generated by monopoly positions in the economy has become, we think, a very significant feature of the global economy over the course of recent years. And there is this there's a very close, I think, interaction between the rise of finance and the rise of corporate power. There's a figure that I don't have here, but in work by Bill Lazonick, who looked at the companies in the S&P 500, I think over the first 15 years of this century, and estimated that of their total profits of companies in the S&P 500, $9 out of $10 of profit was used either for buying back shares or paying out dividends, which left less than $1 for the reinvestment of those earnings into a productive investment. And I think that notion of a disconnect between the financialized and the real economy is a very poignant one when trying to understand the dynamics of this hyper-globalized world. The last element I think that we focused on, of course, is the one that we've already been talking about: the rise of neoliberalism and the endless austerity that has tended to accompany and the squeezing of fiscal space available to governments in both the developed and the developing world, and to some extent this figure on government spending on goods and services over the last few decades is obviously, again, there are fluctuations, but the trend is very much downwards, with one exception, at least one exception, one notable exception. In the slide on the right hand side, the blue line is, of course, the spending of China, government spending by China, which has actually been on a significant rising trend. So these are the kind of forces that we see as having shaped this highly unequal and unstable global economy over the last two or three decades. And just to give you the kind of sense of the problems that has generated, our focus, as I say, is on developing countries, but I think these are ubiquitous features of this hyper-globalized world that true of developed and developing countries. That generates a very different narrative from the kind of Panglossian view of these changes that has been propagated by many economists in the narrow sense of the term, and many international bodies that see in these forces a very benign outcomes in terms of improving efficiency, the benefits of competition, the rise of entrepreneurship, a whole language that we think really does not capture the stresses and fractures that currently we think characterize the global economy. One, of course, that is becoming more and more apparent and more dangerous at the moment is the rise in the level of indebtedness in the global economy over the course of the last 4 decades. That's true in the world as a whole, where we're in excess of $300 trillion of debt in both developed and developing countries, but also the rise in emerging and developing countries over the course of the last 3 or 4 decades has been significant. And it's been significant not just in terms of public debt, which is often where people focus, but very much in terms of private debt, and that's been on a much sharper increase than public debt, certainly in developing countries, but I think in advanced economies as well. And levels of debt distress have now peaked in many countries, and we're seeing the consequences of that in terms of defaults that are already taking place as a consequence of the additional stresses that have been imposed, first of all, by the COVID shock, and subsequently by the consequences of the war in Ukraine and Sri Lanka and Lebanon and Zambia and other countries are now in default, and a growing number of countries are increasingly close to defaulting on their existing debt, with huge consequences for lives and livelihoods in the countries that do get hit. Sorry, that was one of the a second. So that problem of indebtedness, I think, is a profound one in the contemporary global economy. The instability of capital flows that has been a feature of financialization is one that we've talked about a lot in the work that we do in UNCTAD. We know how unstable these flows are. They are short term in nature. They are footloose in character, and they can flip in and out of countries very quickly with quite devastating consequences. And the sense of instability, I think, that many countries in the South face is captured in this chart on net capital flows to low and middle income countries over the course of the last 20 years or so. And that volatility, of course, makes it very difficult for countries to take a longer term perspective on the kinds of challenges that they face, and can subject them to very rapid turnarounds in terms of their growth performance as investor confidence is sapped and capital flows out of countries, having secondary effects on a country's exchange rate, and which is now happening, of course, in the consequence of the current downturn in the global economy and the actions of the Fed in a very significant way, with countries seeing 10 or 20% declines in their currencies, with countries having borrowed extensively in dollars. This is a profound shock that is happening right now in countries. So that sense of instability, I think, is a profound one that we're watching in the global economy. I think one of the most and one of the least, I think, addressed issues in the forces that have come out of this hyper-globalized world is that whilst finance has mushroomed, financial flows have mushroomed over this period, the rates of real capital investment, capital formation in buildings and machines, human capital, has either been stagnant or declining over this same period. And so the big sell of this financialized world, that it was going to create a more efficient and dynamic investment climate, is clearly not taking place in either developed economies or the vast majority of emerging economies, again, with the exception of China, which is an exception to many of the things that I've been saying here, and itself needs to be addressed. Of course, I don't have time to do that. But that disconnect, again, between the financial sides of the economy and the real sides of the economy, I think is very apparent from the figures that we have in this chart on finance here as measured by total external assets and liabilities. For the world, these are figures, aggregate figures, obviously, and the blue line for capital formation. And that is a profound challenge, I think, for all countries in the global economy as we face the climate crisis and the delivery in developing countries of the Sustainable Development Goals, which can only be delivered if rates of, in the way that I think Jim talked about in his presentation, can only be delivered through higher rates of capital formation. And clearly the current environment is not delivering that in any way, shape or form. Another feature of this hyper-globalized world that I think, again, I'm sure is familiar to all of you, is the levels of inequality that have emerged alongside this financialized and highly indebted world. And there are different ways of presenting inequality. We've chosen a particular focus that I think that has been neglected, which is to look at the inequality from the functional income side rather than the household side. So that's the distribution between wages, profits, and rents. And I think there's a famous, I guess many of you know, the work of Branko Milanovic, who came up with an elephant graph to describe the distribution of global income with which had a beneficial side to it in the growing share of China and India in the global economy. I think this is a particularly telling chart in terms of our story, which shows the rising share of transnational corporations' profits in the global economy, and the scissor that goes in the opposite direction, which is the share of labor income in the global economy. And there has been this very noticeable trend at the aggregate level, but also across most countries, of a declining share of labor income in GDP over the period in which we've seen the forces of finance and corporate power take hold of the global dynamic. So the inequality question, I think, is key to understanding the kind of dynamics of this hyper-globalized world. The last one, and I'm not going to talk, and Jim talked about this anyway, is of course the climate challenge and the consequences that is having now in terms of the damage it's causing to particularly developing countries, but now we know not only developing countries, and I don't need to go into the consequences of that. But the instability, the uncertainty that is now surrounding the climate challenge can only be met, I think, in the way that Jim, I think, began to describe. It requires a change of course in terms of policy if we are going to prevent the kind of existential threat that is implicit in the changing climate that we're experiencing. And clearly that is not doable under the current framework that has been created by this neoliberalized and highly financialized world. So a lot of the work that we've been trying to do, in a way, is doing what is very much mirroring what Jim talked about in the need for a fundamental change in the way in which policy at the national level is pursued. And I think these are the elements that we've talked about in the work that we've done, arguing for Green New Deals, both in the advanced and the developing world. And it's a familiar set of ingredients. I don't think I need to go into it in any detail, but we can't make this transition away from the current arrangements in a world of austerity. So we need to ditch austerity and shift to what we would call a wage-led growth strategy. We need a lot of public investment. Private investment will be important, but it can't lead the process, I think, for the reasons, again, that Jim talked about. And so there needs to be a real public investment push into both different sorts of energy systems, but also in the related areas that need to expand around the care economy. For example, we need to change the taxation system. We need industrial policy to make sure that private investment supports this kind of transition rather than works against it. And we need different types of financing arrangements that are supportive of productive investment and employment, rather than endlessly speculate on asset prices and arbitraging, which I think is true of much of both the commercial banking system and the shadow banking system that has grown significantly over this period. And again, just to repeat what Jim said, this requires planning. It requires strategic planning. It requires policy coordination at the domestic level across a whole range of policies if we're going to change course in a direction that can not only address the climate challenge, but can do it whilst also addressing the problems of inequality and insecurity and unsustainable debt, which has been a feature of this hyper-globalized world. I guess our point is that many countries, I think all countries actually, but particularly the countries that we look at in the developing world, cannot be expected to undertake this kind of strategy and shift without support from and determined support from a functioning multilateral system that can channel the resources and to support this kind of move in developing countries. And this is our big issue because we don't think that the current multilateral system is fit for purpose. Indeed, unfortunately, we would argue and have argued extensively that in many respects, the current multilateral financial institutions have encouraged precisely the forms of hyperglobalization that are part of the problem that we face, rather than a solution to those problems. And to some extent, the book that Manfred kindly mentioned tries to go into the history of the evolution of multilateralism. I don't really want to go into that today, other than to suggest, at least it's implicit in the arguments we present, that the way in which the IMF and the World Bank operate today are much closer to the League of Nations in the 1920s and the kinds of economic advice that it extended then than it was to the principles of the people that founded Bretton Woods in the 1940s. We call those the Morgenthau principles because these were the principles that Morgenthau himself articulated when he presented the case for the US agreeing to the Bretton Woods document, when he presented that to the Money and Banking Committee of the US House. And these were the basic principles that he identified as being the ones that the Bretton Woods institutions would pursue, and why these were good for the American people was the case that Morgenthau made. We argue in the book that those principles have been lost in the current operations of the multilateral financial institutions. We need to recover those principles if we're going to move forward. But recovering those principles is not enough. I mean, there were real weaknesses in the original design of the Bretton Woods institutions, particularly with respect to developing countries. And so it's not simply a question of going back to these institutions as they were set up in the 1940s. It's very much the need to reform those institutions in light of the challenges that we face in the 21st century. And those are much more demanding challenges than was true of the operations of the Bretton Woods institutions in the 1950s and the 1960s, partly because we have to add green structural transformation to national policy goals, partly because I think we need to bring development much more forcefully into the way in which these multilateral financial institutions operate, and that was, in our view, something that was not done properly in the 1940s and subsequently over the next 2 decades, which was a kind of golden era for these institutions. And to do that, we need to reform. We need to see some serious reforms to the international financial system. We need to see serious reforms to the international trade and investment regimes, and we do need to see a huge scaling up of development finance. And I don't want to run out of my time, so I don't want to abuse my time. We offer a series of reforms to the monetary, trade and financing systems that we think will be necessary if the kind of policies that we have been articulating, and I think that Jim articulated, are going to become the dominant policy paradigm at the national level over the course of the next few years and decades. And that crudely involves this mobilization, a stepwise increase in what the World Bank in particular, but also its sister organizations were meant to do, which was development financing, and to bring in the climate goals as well as traditional development goals into those into the workings of those institutions. It means in particular in the context of the trade regime, of reducing the level of interference that trade agreements at both the net multilateral and the regional level have introduced into that system. It requires far more regulating and monitoring of the large players in the international trading system, and international trade is not dominated by small enterprises and medium-sized enterprises. It's dominated by very large corporations, as I suggested earlier, and those can only be properly regulated at the international level, and we need to think about ways how we do that effectively. And it requires a series of what we call incremental changes to the workings of particularly the IMF and the World Bank in terms of the way in which they allocate liquidity to ensure that the deflationary option is not the default option for correcting imbalances in the economy. The role of special drawing rights, which is the reserve asset that the IMF can create, becomes a much more potent tool in preventing the kind of deflationary developments that we are currently seeing. We think that's we think there are real possibilities to do that. We try and outline those in the book. We do recognize that there needs to be a real increase in the capital base of the World Bank and the IMF. They're very conservative lenders. They need to be, ironically, willing to take greater risks and not simply to fixate on their AAA rating, which is what they do currently. We would very strongly argue if they're going to get more capital, however, they need to prune back their tendency to dictate policy options to developing countries, options that tend to be very neoliberal in their orientation and have largely produced a kind of distorted pattern of development in the countries that have been forced to borrow from developing countries. So yes, more capital is needed in these institutions, but they need to get out of the job of dictating policies to the countries that come to borrow from them. We would argue in that context there's a bigger role than is so far taken by regional financial organizations. I think they need to be scaled up significantly. They have a better feel for the challenges that countries face than we think the multilaterals tend to have. And there's a big role in them backing national development banks, as I mentioned earlier. The real big reform that we advocate in the book and in the work that we do in UNCTAD is the need to have independent mechanisms to deal with unsustainable debt levels. If we don't remove the burden of debt from many developing countries, the just transition and the sustainable development goals will simply not take place. It's impossible for countries to mobilize the kind of resources on the scale that we're talking about when they are flattened by this mountain of unsustainable debt that they've acquired over the course of the last 2 decades. And the only way we think to do that is through a proper multilateral debt restructuring mechanism, not in the IMF or the World Bank, because they are themselves creditors. It needs to be independent of creditors, and it needs to be able to enact measures in a timely and as fair way as is possible, including not just for the multilateral lenders, but very importantly for private lenders, because they have, over the course of the last 2 decades, become much more significant players. That's, for us, the big reform that needs to take place if we're going to make the kind of course correction that I've briefly tried to outline, I think. And I think that the one that Jim also outlined in his presentation. So let me leave it there, Manfred. It was a little rushed, but I hope it was of some use and interest.
Not only was it of some use of interest, Richard, it was incredibly pertinent and focused. I really want to draw attention to the fact that some of your graphs were really very striking in illustrating the core forces that have led us to this impasse. Particularly the emphasis and the clear statistical reflection of the increasing monopolization of the world. I won't take too much of the time here, but the absolutely fundamental contradiction in the neoliberal model. And it has been that it has led to dramatic income inequality, which the crocodile graph illustrated and which we all know about it. But that process has created a huge contradiction, because as profits and profitability has increased, real spending, real purchasing power has been throttled. And that was, of course, Keynes's insight in the 1930s, why he tried to shift the whole focus of economics. And as a result, capital has increasingly moved into speculative, rent-seeking activities. And that is what is, to a very significant degree, driving the current inflation process. And in that context, the use of higher interest rates to try to curb this process is extremely ill-advised and even absurd. In any case, let me open the floor. I know Susan Tanner has a comment. So where is the microphone? Oh, we're so far.
Thank you very much, Richard. I can remember back to listening to you at IDRC and a similarly wonderful presentation. Thank you. It's your last slide on the horizon that I'm worried about. It's a double-barreled question. Sitting where you are in the center of the world, so to speak, what do you think is on the horizon, or the timing that we might have on any of these changes? And in that question, I'm also wanting to ask you about what kind of consideration there is about biodiversity collapse. We hear a lot about climate now, but biodiversity collapse is the partner. And I'm worried about the prospective collapse of food sources around the world. And we all know that famine relates to war. So to circle back to the horizon issue about timing, do we have any chance at all? Thank you.
Thanks, Susan. It's the big question, of course. What are the forces? Where are the forces for political change? I mean, one of the frustrations of an organization like UNCTAD, which was the secretariat really, that backstopped the efforts of developing countries in the 1970s to argue for a new international economic order. The developing world is simply, it doesn't have that kind of political cohesion or forcefulness at the moment that characterize that moment in international political economy, and then we can think why that. Well, we kind of know we know that the debt crisis of the 1980s was a major fragmenting influence on developing on the solidarity of developing countries, and that's a frustration for an organization like UNCTAD that as developing countries have become more fragmented, has become a much less powerful voice in the multilateral discussions. Having said that, there are signs, I think, of new thinking and new arrangements in the developing world that I think hold out some possibility of them providing a degree of countervailing influence. That's, to some extent, that's true of the emergence of the BRICS, although that's a very heterogeneous group of developing countries that don't necessarily see eye to eye on all matters, but that's happening. You have to bring in China here, and I know it's a controversial issue, and people have different views of whether China's actions are contributing to a different way forward or acting as a barrier to progress. We argue that China has played a positive role. I think there are things that China has to do differently, including on issues around debt, but it is being forced into thinking about these issues now, given the current circumstances. And so China's role, in one way or another, is critical to forging a different sort of framework for international cooperation. Without China, it won't work. That's clear. And I think when you add other developing countries to that, there are some opportunities. We have seen the emergence of new regional financing arrangements over the course of the last decade. That's true of the New Development Bank. It's true of the BRICS Bank. There are certain liquidity facilities that have emerged over this period that suggest a move in a more positive direction. None of them on the scale that we need to deal with the kind of problems that we've been talking about, but they are steps, I think, in the right direction. I guess the source of frustration for us is in the advanced economies. And I would have to argue. I wouldn't argue it in my day job as a UN official, but the failure of Europe. I think when the new international economic order was a serious attempt to reconfigure the global economy, it wasn't just the developing countries that felt the need to do that. I think it was also true of the European economies. The US had essentially abandoned the original Bretton Woods design by cutting the link of the dollar with gold and essentially floating the dollar, and without consultation with the Europeans, of course. And the Europeans played, I think, an important and constructive role in the 1970s about thinking about a new international economic order. I see absolutely no signs of that coming from Europe in its current 21st century manifestation, and that's a real source of frustration, I think, for us. And whether Europe in particular. Ironically, in a way, the Biden discourse was a more positive one. It turned out to be ephemeral, but it was a much more positive one than anything that came out of Europe around the consequences of COVID. Whether there's a internal dynamic in the United States that can recover that initial discussion that we heard around the time of COVID, I'm beginning to be rather pessimistic about. But I have to say, for the first time in my time in UNCTAD, we actually were able to have a dialogue with policymakers in the US, which hadn't happened before. They started to think about industrial policy as an important element of a more resilient economy, for example, and that opened up possibilities, I think, for discourse that could bring in the development dimension. So I don't know. It's very easy to be pessimistic. I think there are positive signs. We have civil society movements, certainly around the climate agenda, that are becoming stronger. I think that's important. And I see developing countries picking up some of the language of the Green New Deal. Lula. A lot in our world for Latin America hinges on what happens in the election in Brazil in a week's time. Lula himself has committed to a Green New Deal for Brazil. That would be an important shift, I think, given Brazil's political and economic weight. There are elements there that kind of are encouraging at the same time that the kind of the larger geopolitics are deeply depressing. On biodiversity, I think you're right. It's not something we've done a lot on. We have done some work on the oceans economy, which I think is related to that concern beyond the question of warming temperatures, and the notion of a blue New Deal is something that colleagues in UNCTAD are thinking about, and the loss of biodiversity, I know, is a real challenge that we're facing. The UN had a conference recently. It didn't make any progress. It didn't make any progress in terms of the blue economy either. We had conference recently on the need for policing the the oceans or regulating the oceans better. In both respects, we still live in a world where corporate power has a profound influence on government policy making, and the oceans are a profitable business for many companies. And until we are, I think, back to Manfred's point, until we're willing, both at the national and the international level, to tackle corporate power in a systematic way, then it's very difficult to make progress along many of these avenues.
Susan.
Hello? Okay. Thank you. Just one last comment. I guess we have one more oxymoron for Jim, which is corporate social responsibility. Thanks very much.
Hello? There we go. Sorry about that. Hi, thank you so much for speaking to us. So you mentioned the impacts of hyperglobalization, and in particular, how despite financial flows having increased, developing countries have not seen an increase in things like infrastructure. So my question is, what solutions would you propose to incentivize investment in developing countries, especially sustainable development, when resources and revenues tend to go to the global financial capitals in the West? Thank you.
Yeah, I mean, in some respects, I mean, we would argue that on things like infrastructure, the financing has to be public goods are best delivered by public finance. We're not big believers in public-private partnerships. We've looked at their record. It's not a very good record. So I think when it comes to something like a lot of infrastructure, not all, because I think there are clearly profitable sources of infrastructure development that can be delivered by private investors. But in many developing countries, as was the case in China, it's public finances that need to lead the way. I would strongly argue that the way to the form of the partnership that would work is by properly taxing large international corporations and using that revenue to support infrastructure projects in the developing world. That will be the form of public-private partnership that I would like to see more of. And to some extent, again, it's one of the positives that we've seen in the last couple of years. There has been a recognition about the dangers of illicit financial flows and the need to properly tax international corporations. We saw the G7, G20 initiative begin to take shape. We don't think it's sufficient, but it's an important step forward. So I would make a strong pitch when it comes particularly to infrastructure development for the need to scale up public financing, rather than to hope we can incentivize private capital to make these kind of big investments in long term and to some extent uncertain investment projects with relatively low returns. It's not going to happen, I don't think, and I think we need to think more creatively about finding resources beyond the private sector.
Richard, thank you very much for a really wonderful presentation. I think the discussion has raised additional issues, and it leaves us obviously with a conclusion which is not unexpected, which is that the obstacles facing a adequate response to the crisis that has built up over the past 30 years are enormous. I can't help but just add, you did mention that Biden's discussion of building back better was briefly helpful and positive, and I would agree with that. But I would have to add also that the US's geopolitical aggressiveness over the last 10 years, as I understand it, and particularly the demonization of China, has created an environment in which the possibility of positive outcomes have received an enormous setback in my mind. I hope I'm wrong, but in any case, you've clearly laid out the issues that we have to address, and hopefully in the next couple of days we can make some further progress in clarifying that. Thank you so much, Richard.
Thank you, Manfred. Thank you very much.